With oil prices spiking and the Iran conflict dominating headlines again, there's a good chance your portfolio has taken a hit this week. You've probably seen stocks dip. Maybe your savings feel like they're losing ground to inflation again. And the big question hits, should I be doing something right now? Do you sell? Do you go all in on oil or defense stocks? Or is doing nothing actually the smartest move? Because what you do in the next few weeks could have a bigger impact on your long-term wealth than you think. In this video, I'm going to walk you through what actually works in situations like this, based on real historical data, and what some of the smartest institutional investors are doing right now in 2026. Hey everyone, welcome back to the channel. If you're new here, we focus on practical, no-hype personal finance, especially during uncertain times like this. Today, we're breaking down how to invest during the current Iran situation without making emotional decisions that can cost you years of progress. And make sure you stick around, because the biggest mistake most people make during events like this isn't what you think. Quick reminder, this is for educational and entertainment purposes only. I'm not a financial advisor. Always speak to a licensed professional before making financial decisions. Let's start with what's actually happening. The ceasefire that began in early April is now under serious pressure. Reports indicate the IRGC has been targeting and redirecting vessels through the Strait of Hormuz, a critical choke point that carries roughly 20% of the world's oil supply. That's why oil prices have jumped sharply. And when oil spikes, markets tend to get nervous fast. So if your portfolio is swinging right now, that reaction is completely normal. But here's what most people get wrong in moments like this. They assume this time is completely different. But in reality, markets have seen versions of this many times before. Let's zoom out for a second. During the Gulf War in 1990 to 1991, when Iraq invaded Kuwait, oil prices surged and markets dropped sharply at first. Fear was everywhere. But within months, the S&P 500 had recovered, and by the end of that same year, it was actually positive. Same story in 2003 during the Iraq invasion. Sharp dip, heavy uncertainty, followed by recovery. Even more recently, during the 2019 to 2020 Strait of Hormuz tensions, oil jumped over 10% in just days. The S&P 500 dropped around 3 to 4%, and then fully recovered within about 6 weeks. The pattern is surprisingly consistent: short-term shock, followed by recovery. And on average, 1 year after major geopolitical events, market returns have historically been positive. The key takeaway? The market looks forward, not at today's headlines. And here's the part that catches most investors off guard. One thing that's really important to understand is why markets recover so consistently after events like this. It's not because the situation isn't serious, it's because markets are pricing in expectations about the future, not reacting purely to the present moment. When something like this happens, prices adjust very quickly to reflect worst-case scenarios. That's why you see sharp drops early on. But as soon as uncertainty starts to reduce, even slightly, money flows back in. And here's the key point. The biggest market moves often happen before the news feels comfortable again. By the time everything looks safe, markets have usually already recovered. That's why waiting can actually be more expensive than staying invested. Now, if you're feeling uneasy watching all of this unfold, that's completely normal. Even experienced investors feel it. Seeing your portfolio drop while headlines talk about conflict and rising oil prices triggers a very natural response. Do something. And that urge right there is where most people go wrong. Because reacting feels productive, but it's often where the biggest mistakes happen. So instead of reacting, let's shift into a clear plan you can actually follow. So what should you actually do right now? Let's make this practical. First, stay diversified. If you're invested in broad index funds or ETFs that track large portions of the global market, you're already doing what most professionals recommend. You're not relying on one country, one sector, or one outcome. These portfolios have survived wars, recessions, and global crises before. And in a situation like this, that diversification really starts to prove its value. Second, if it helps you sleep at night, consider a small allocation to shock absorbers. Assets like gold, government bonds, or even holding a bit more cash can reduce volatility. You don't need to overdo it. Even a 5 to 10% allocation can make a noticeable difference. Not necessarily in returns, but in your ability to stay calm and stick to your plan. Third, be aware of sector movements, but don't chase them. Yes, energy and defense stocks often see short-term gains during geopolitical tensions. But by the time it's in the headlines, a lot of that move has already happened. And this is where a lot of retail investors get trapped, buying after the spike instead of before it. Fourth, and this is the one that matters most, keep investing consistently. If you're dollar cost averaging, putting money into the market on a fixed schedule, volatility actually becomes your advantage. When prices drop, your money buys more shares. And this is where things start to compound in your favor. Here's a simple example. If you invest $500 every month, regardless of what the market is doing, downturns like this mean you're accumulating more assets at lower prices. Over 10 or 20 years, that difference alone can add tens of thousands to your portfolio. And this is where most people underestimate the impact, because it doesn't feel dramatic. It doesn't feel like you're making a big move. But consistency during volatile periods is often what separates average investors from successful ones. A lot of wealth is built during times like this. It just doesn't feel like it in the moment. Now here's where it gets really interesting. Let's look at what some of the largest asset managers in the world are doing, because these firms are managing trillions of dollars. Goldman Sachs has lowered its US growth forecast for 2026 and expects slightly higher inflation due to oil. But importantly, they still view this as a temporary shock, with oil potentially settling back towards $70 per barrel if disruptions ease. JP Morgan has a similar view. They don't expect prolonged supply disruption and believe any escalation would likely be contained. BlackRock has emphasized staying diversified and using volatility to improve positioning rather than reacting to headlines. And Vanguard points to the oil futures market, which suggests investors are expecting this situation to stabilize relatively quickly. So when you zoom out, the message across all of them is surprisingly consistent. Stay invested, stay diversified, don't try to time geopolitical events. Now you might be thinking, what if this situation actually escalates? What if oil keeps rising or markets fall further from here? That's a fair question. And the honest answer is, in the short term, that's always possible. Markets can absolutely go lower. And this is where having a plan matters more than having a prediction. Because if things get worse, long-term investors are simply buying more at lower prices. And if things stabilize, they benefit from the recovery. Either way, the strategy holds. Trying to predict which path happens next is where most people run into trouble. Now, just as important, what should you avoid? Don't chase war stocks just because they're trending. Don't try to jump in and out of the market based on headlines, and don't let fear dictate big financial decisions, because those decisions usually happen at exactly the wrong time. The bottom line? Prepare, but don't panic. Markets have been through far worse than this and continued to grow over time. If your plan is solid, your long-term goals are still very much intact. And moments like this are part of the journey, not a signal that the plan is broken. And one final point that often gets overlooked: make sure your foundation is strong. That means having an emergency fund, keeping high-interest debt under control, and making sure your financial life isn't dependent on short-term market movements, because that's what gives you the ability to stay calm when situations like this happen. This is for educational and entertainment purposes only. I'm not a financial advisor. Always speak to a licensed professional before making financial decisions. If this video helped you feel more in control, drop your biggest concern about the current situation in the comments. I read every single one. And if you want to be better prepared before the next crisis hits, make sure you're subscribed. Thanks for watching, take care of your money, and I'll see you in the next video.